Hello, and thank you for joining us for this short session on understanding accounts for non-accountants. My name is Paul Samra. I'm partner at Chartered Accountants and Business Advisors Moore, Kingston, Smith, and we specialise in owner-managed businesses and the not-for-profit sector. So I hope you find this session, part 2 of understanding accounts for non-accountants, helpful and informative. So in part 1, we looked at accounting reference date, balance sheet date, and the year-end date, and covered off the cash and the accruals basis of preparing a set of accounts. We also started to dig into a set of accounts and picked up the director's report and what is included in the director's report. In part 2, we're going to move that on and look at audit reports, accountants' reports, and then starting to dig into the jargon that accountants frequently use that confuses rather than assists clients. But I'll hopefully try and make sense of some of the jargon. In part 2, we're specifically looking at the profit and loss account. Part 3, we'll be looking at the balance sheet. So as we said last time, director's report, director's responsibilities are included in a set of companies' accounts. And then the reports there, we have the audit report or an accountant's report or a statement that the accounts do not need an audit. More on what an audit is in a moment. Then we have the profit and loss account, the balance sheet, possibly a cash flow statement, depending on the size of the business, and notes to the accounts, which contain a lot of information. And if you're like me or like any other accountant, you're fascinated by reading a set of accounts because you can pick up so much about a business. So we picked up on what was included in the director's report last time in part 1, specifically director's responsibilities now. And it's quite important that if you are asked to be a director, you understand what your duties are. And it does require you to act in a fiduciary capacity such that you are safeguarding the assets and liabilities of the company. And under company law, the directors must not approve the financial statements unless they are satisfied that the accounts give a true and fair view of the state of affairs of the company. So you must prepare financial statements on what's called the going concern basis. That means that the company is expected to continue to trade for at least and past the next 12 months, unless there is a appropriate reason to believe that actually the company may not continue as a going concern. And obviously with the pandemic at the moment, clearly there are significant considerations to bear in mind when you are preparing a set of accounts, because normally they are prepared on the basis that the company will continue trading for at least the next 12 months. Continuing on, the director's responsibilities, the provision of information to the auditors must be full, and they must have disclosed with every effort anything that they might think is relevant to the audit. And they're responsible for safeguarding the assets of the company, and the directors are responsible for taking reasonable steps for the prevention and detection of fraud. And that's part of the director's responsibilities that are included in every set of accounts. And so we come on to audit. Now, an audit, what is an audit? An audit is an independent examination of the company's accounts to support the report that would normally say the accounts give a true and fair view. We're not saying they're correct, we're saying they're true and fair, because obviously if you're dealing with a multi-million-pound company, we're not particularly interested in petty cash of £500 not being accounted for, on the basis that the omission of that £500 would not materially affect or distort the view given by the audit report and the reader reading the accounts. So we have to bear in mind what we have as a concept of materiality. To bear in mind, would the exclusion of something or the inclusion of something change the viewer's, the reader of the accounts, view of those accounts? So for an audit, by and large, you're looking to have two of the following, two out of those three, and then you are exempt. So quite a few small companies, by definition, will not require an audit. If the shareholders in excess of 10% shareholding require one, then you would have to have an audit. But provided they don't, then you're below the limits. You will not need to have an audit. You still need your accounts prepared and submitted to the Registrar of Companies, Companies House, compliant with the Companies Act, but it will not contain, your set of accounts will not contain an audit report. So those are the thresholds for disclosures, because there are limited disclosures depending on the size of your company. And there you are, you've got the list there. So if you're a very, very small entity, then there is very little information put on public record in respect of your accounts. If you're a medium-sized company, almost everything needs to be disclosed. There is very little exclusion, to be honest. But if you're a small or micro entity, then there is limited information that is placed on public records. Certainly, you would not need to disclose your turnover on public record. Now we come on to the audit report, and this audit report goes on for, oh gosh, how many slides is it? About 7 or 8 slides. It used to be quite brief. It used to be a couple of paragraphs when I started training. Shows you how old I am, or how quickly, rather, they change from just a couple of paragraphs to 8 slides worth. There we are. We've audited the financial statements. This is being given by the auditors. So the auditors are signing this report, and obviously, if you go to a set of accounts, the first thing you do should be to look to see whether there's an audit report. If there isn't, it's almost certain that the company was exempt from an audit, and no one other than the directors are confirming that the accounts give a true and fair view. So, conclusions relating to going concern, we have nothing to report there. And we believe the company can continue to adopt the going concern basis for a period of at least 12 months from the date when the financial statements are authorised for issue. And then it continues, other information on the basis of material inconsistencies or misstatements, as I touched on earlier. We conclude that if there is a material misstatement of this other information, we are required to report that fact. And in this case, we have nothing to report in this regard. So it's leaning towards what's called a clean audit report. And we have nothing to report in respect to the following matters. We have no reason to believe that adequate accounting records have not been kept. Disclosures, we've received the relevant information and explanations. So all positive. We have nothing to report in respect of not receiving such information. So we recognise what our responsibilities are, having stated what the director's responsibilities are, and then it carries on so far as understanding how the processes work within the accounting department and processes of the client. We understand the internal controls, and we have evaluated the appropriateness of accounting policies. We'll come on to those later. And it continues. So it is quite extensive. It is quite wordy. And finally, you get the signature, the magic signature, and confirming that the report is made solely to the company's members, the shareholders. It's quite a detailed narrative, as I say, but it reminds us all of the duties and obligations on the auditors, on the directors to be acting in a fiduciary way, manner, and giving all the necessary information and not withholding anything from the auditors. And the auditors have to be very objective. They have to be very dispassionate. They need to take a skeptical view and then gather evidence that supports their opinion. So they will have copious working papers to ascertain with third-party verification where appropriate. So they will have undertaken attending at stock take. They will have confirmed various details with the bank, with property owners if the properties aren't owned by the company, etc. And lastly, in part 2, we're going to look at the profit and loss account. And wonderful animations there, because the profit and loss account covers a period ending on the accounting reference date. So it might well be the profit and loss account for the year ended 31st December. So it picks up everything and sweeps, rather like the hands of a clock. Picks up everything that's occurred in that period, typically a year for accounts that are filed at Companies House. For management accounts, it might be just for a quarter, for 3 months. So it picks up everything that's occurred throughout that period. And remember, in part 1, we talked about the accruals basis. Here, the profit and loss account will pick up everything that has been invoiced and relates to the current period, and we'll bring that in as sales or as expenses. So everything that relates to the period, the whole 12 months, will be brought in to the profit and loss account. It isn't just a question of picking up an invoice and putting it in this set of accounts. We need to make sure what period that invoice covers. And if it covers a period longer than a year, we would only bring in a year's worth of that expense, because we are preparing a set of accounts for a 12-month period and matching the sales and the expenses that relate to that 12-month period. So very important to understand the accounting period length and then to pick up things that relate to that period, whether paid or payable or received or receivable. So in the part 3, hope you'll join us for that one. Part 3 delves deeper into the jargon within a profit and loss account and within the balance sheet. So thank you for joining me, and look forward to hopefully seeing you for part 3.